Shares of both Uber and Lyft are recouping their pre-session losses, and they're actually higher today by 1% to 2%, despite that new federal court ruling in California, which said that last year's Prop 22 vote was unconstitutional. Prop 22 allows gig companies to deem workers as independent contractors rather than employees. Appeals are expected, but overturning the exemption could be expensive for these companies. They already sunk, I think, $200 million into all this. Morgan Stanley's Brian Nowak says Uber can manage its regulatory issues and sees 80% upside in the shares, citing a growing delivery business, saying Uber Eats could be undervalued. And Brian is here to join us now to discuss this. It's good to have you, Brian. So, I guess the main question is, how much more of a fight is there still going to be over this issue of driver categorization? I mean, we were talking about this morning, but if they had to be employees, would it destroy Uber's business model?
Yeah, thanks for having me, Kelly. I think I'd say a few things on the regulatory discussion. Number one, I would not expect headlines to go away in the near term. However, point two, as long as job creation and worker flexibility remain important, which we think they are. For perspective, the gig economy employs tens, even over 100,000 people in California alone. We're talking about a couple million people in the United States alone. We think that the current voter-approved structure, Proposition 22 in California, is appropriate. Now, could there be changes to it? Could you have amendments to it made where maybe there is worker compensation that's made to it or added to it, or collective bargaining that's added to it? Absolutely. However, I think it's a pretty low probability that you're going to have case law and a voter-approved Proposition 22 completely overthrown, and we move toward a far more stringent regulatory structure that would hold back job growth and actually lead to just fewer people making less money across the entire United States gig economy.
Yeah, it was strange to see a judge overrule a vote by the public, basically saying he thinks they don't understand, the history. Again, I would have to read more into it, but it seems like a pretty big move to tell voters, no, you don't understand, and to rule it unconstitutional. So let's just put that aside, but point out why this is important. To the ultimate question of profitability, you see a couple ways that Uber gets to, some decent EBITDA in the next year or two. Rides, obviously, rebounding, reduced fixed costs, platform benefits, the delivery business. So, the question of fixed costs is a big one here, right?
Correct. I think, through everything that's happened since Uber's initial public offering a couple of years ago, and then we went into shelter in and all of COVID and everything else, I think the market needs to remember a few things as we head into 2020, 2022, and 2023. Number one, fundamentally, ride sharing is a cash flow generative business. It's a very healthy business that, as long as you don't have excess discounting and couponing from competition, which we don't think you're going to have, the business actually does throw out healthy free cash flow and EBITDA. And you can see that across multiple countries now, where Uber ride sharing is generating 60% plus EBITDA margins in multiple countries around the globe. Point two, you brought up the cost cuts. Uber's a company that last year took over $1 billion of fixed costs out of its company-wide OpEx. And so as we think about recovered rides and even still growing Eats volumes moving into 2022 and 2023, the incremental leverage flowing through from that should be pretty strong. So we think the market is underappreciating what we think could be $2 billion plus of EBITDA next year as we recover, heading to $3 to $4 billion of EBITDA in 2023.